Benzinga's own Mark Putrino. He's going to be doing a little bit of technical analysis live on air. Is that right? Mark, are you out there? Let's get Mark up here. I see him backstage. There he is. What's up, brother?
Hey,
what's
how
up,
are you?
Man? I'm doing well. It's me. It's Brent.
Cool.
I'll let you.
I just want to give a little disclosure that my IQ is probably 50 points lower than Jeff's, but hopefully
seemed like a smart guy, right? Mark, I'm sure you are a very smart guy. Don't do that to yourself.
Well,
let's let the audience, let's let the technical analysis speak for itself. At the end of this, people are going to be like, "Wow, that guy Mark was really a smart one." I'll let you have it, Mark.
All right, cool. Thank you, sir. Thank you very much, and thanks everyone for tuning in. So my name is Mark, and I'm a market technician, and I'm the head educator at the Benzinga Trading School. The reason why I'm a good fit for this role is because I have an extensive background in the institutional trading world. My first trading job was working for a very well-known manager by the name of Mario Gabelli. If you watch the NBC, he's on there all the time. You've probably seen him. I spent some time also trading for Stevie Cohen, who is one of the best traders in pretty much the history of trading. He is the guy that the show Billions is allegedly based on. And then after that, I had a chance to go be a head trader at a fund. And, being a head trader, I had traders underneath me that I supervised and so forth. So I spent about 25 years in the institutional investment industry. So I've been around the block more times than I care to remember. And I want to take this knowledge and I want to teach people, because there's a lot of disinformation out there. There's a lot of misinformation. There's a lot of fraud. There's a lot of scam artists. There's a lot of garbage. I'm just going to give you just kind of a little anecdotal thing about what I mean. Not too long ago, I saw someone touting a newsletter or promoting a newsletter talking about how great their returns were. And this particular newsletter and this particular person said, "We doubled our money in 1 week." Okay. So now I know that can't really be right. So it seemed like a pretty dubious claim. So I did a little bit of research and I looked into it. And it turns out that this person gave a buy recommendation of a stock that was trading at literally 1 cent. Okay. And then the next week it went to literally 2 cents. So he claimed he doubled his money, but that's not how the market really works. For every stock, there's what we call a bid and there's what we call an offer. The bid is the highest price that anyone in the market is currently willing to pay. The offer is the lowest price that anyone is currently willing to sell at. So there's a bid and an offer in every stock. The offer is always higher. The bid is always lower. So I looked at this particular stock and the bid was 1 cent. The offer was 2 cents. So that means if someone sold 100 shares, it would have shown a trade at 1 cent. If someone came in right after that and bought 100 shares, it would have shown a trade at 2 cents. All right. So what do we have here? On paper, the stock doubled. It went from 1 cent to 2 cents, but it didn't really move. Okay. It didn't really move. Going from 1 cent to 2 cents is not the same as going from 10 to 20 or 20 to 40 or 40 to 80. So when I see things like that, I get upset because I don't know. I just think it's wrong that there's scam artists out there. So what I like to teach people is that the traders in the institutional world, guys like myself, we don't follow a lot of these like fancy esoteric techniques that a lot of people talk about, like Gann theory or Elliott wave. When we're The main thing that an institutional trader is looking for when he looks at a stock or she looks at a stock is which price levels are more important than others. In the stock market or in all financial markets, there are certain price levels that are more important than others. All right. It's the most fundamental rule of trading. And what we teach in the class is how to determine which levels are going to be important. Now let's take a look at this because we're talking about healthcare today. And I wanted to bring this up. This is the iShares Biotechnology ETF. The symbol is IBB, like Isaac, boy, IBB. Now, when we look at this chart, what do we see? We see that this 158 level was an important level for this ETF. All right. We can see it was resistance here. And then we can see it was support here. Okay. Resistance is a wall of sellers or a large group of sellers that are all trying to sell at the same price. In this case, obviously, it's 158. Now, at a resistance level, there's more supply of shares than there is demand. So what happens? Well, when a stock rallies and gets to a resistance level, the buyers can buy all they want to buy. They don't need to pay any higher prices. The stock is not going higher. A lot of times when things hit resistance levels, they sell off. Okay, now we can see again, we have $158 was resistance here as well. All right. So again, it sold off. So the buyers are buying it. They have to pay higher prices because there's not enough supply around. And when it gets up to 158, all of a sudden the sellers come out and the buyers can buy all they need to. Now, and I really want to emphasize this a lot. Looking at chart reading, at least the way I do it, is not anything mysterious or magical or mystical. It's not reading tea leaves or astrology. A chart needs to be seen in the context of what does this tell us about the supply and demand dynamics that are occurring in a market. All right. That's what you need to do when you look at a chart. When we see a resistance level, what are the supply and demand dynamics? Well, there's more supply than demand. Okay. And the support level, it's the opposite. This is buyers looking to pay the same price. Now, look at this. And this is really kind of astonishing if you really think deeply about it. And I've been doing this for years. Look at how what was resistance turned into support. Okay, so we can see the 158 level here was resistance. Again, resistance is a large group of sellers all trying to sell at the same price. They can sell all the shares there's a large group of sellers here at 158, so they're trying to sell and they can fulfill all the buy demand that there is. Now over here it's support. There's enough demand to absorb all of the supply. How did this happen? How did a level that was resistance turn into support? This is a very common occurrence in stock markets, especially when a market is rallying. What was resistance can become support. Write that down. Tell yourself it over and over and over. What was resistance can become support. Now, obviously, there's the question as well, why does this happen? This seems like a little kind of an odd thing. Why would a resistance level turn into a support level? Well, the reason why is seller's remorse. Okay? Seller's remorse. These sellers here thought they made a good move when the stock went lower. Okay, same thing here. The stock's at 158. These people sell and the stock goes lower. Now, what happens here? It goes and this resistance finally breaks. The buyers finally are able to overpower the sellers, and that makes it higher. Now, a lot of these people that sell experience seller's remorse. They say, I sold at 158. Now this darn thing is higher. I made a mistake. I think I'm going to try to buy it back. But you know what? I want to kind of erase my mistake mentally. So I'm going to try to buy it, but I'm only going to do so if I can buy it at the same price that I sold it at. So what happens as a result of this? People that were sellers that become remorseful place their buy orders at the same level that they sold at. In this case, it was 158. If there are enough of these buy orders, it creates support. And that's what happened here. So a level that was resistance can turn into support. So just remember, probably the most important trading dynamic outside of the investment psychology realm, but just in terms of understanding the markets, is knowing that there are certain price levels that are more important than others. It seems like simple stuff, and it can be pretty deep, but we can also try to really keep it simple. And just by knowing where these important levels are, it can really help us make our good trading decisions. Now, we can see here's another example of a level that's important. This is 175. It was resistance in early August, and the stock went down. And then when it got back up here again, it was resistance. So now we know the 175 level is important. If this thing ends up rallying and getting back up to 175, I will bet you that there's a good chance it's going to run into resistance again. That doesn't necessarily mean it's going to roll over and go down. It might spend some time consolidating or trading sideways. That's a term we use for when a price isn't really moving. It could trade sideways for a period before finally breaking through. But just by having an awareness of where these important levels are, it gives us an edge on the vast majority of people that don't look at this kind of stuff. But like I said, in the institutional trading world, in the hedge fund world, when I get an order to buy 1 million shares of Intel or sell 3 million shares of Apple, you got to know where the support levels are, because you got to figure out like what price you're going to sell it at, or how is that going to affect the market. If you have a big sell order and you're here and you see there's support, well, you can go ahead and sell, because there's enough buyers to absorb all of the supply, and like you can sell all the shares you want. If you're here and you got a big sell order, well, now you're going to have a problem. There's not enough buyers around, so the thing goes down, or it keeps going down. So that's just a quick look at how a resistance level can become support. And now I want to just explain this on how what we call a technical trader would potentially approach this. The technical traders are different than fundamental investors. Fundamental investors look at things like price to earnings ratios, dividends, and they're kind of, I guess you would say their primary focus would be the accounting of a company, like studying the income statement, studying the cash flow statement, understanding if the company is becoming more profitable, less profitable. That's what fundamental analysts do. Technical analysts just use the market, and we let the market tell us what to do. So why am I bringing this up? Well, IBB has been in a free fall. It's gotten really beaten up, but it's getting close to this level that was support before. Now, there's an old saying that markets have memories, and that means that a level that is support or resistance can stay intact for a while. So it was support here, it was support. So this means if this thing gets down to around 158, there's a good chance that it finds support again. All right. So that could put an end to the sell-off, and it couldn't even rally again. But what happens with most people is when they go to try to bottom fish, that's called trying to call the exact bottom, or just getting it at the low trade before the thing rebounds. That's kind of like not possible usually. I mean, sometimes people get lucky, but there's a good chance that IBB goes lower and it gets to this support, and the support breaks. And in that case, the IBB will keep going down. So what do we do to prevent us from buying a stock and getting run over, or buying an ETF, in this case, and having it just go lower and lower and lower and getting what we call run over and losing your money. Well, what we have here is a downtrend line. Okay. Now, this trend line is a graphical illustration. That's what stocks charts are, graphical illustrations of supply and demand dynamics. This black line shows us that the bears are in charge. All right. So what do we want to watch for? Well, we want to watch to see if IBB trades on the other side of this line over here. The breaking of this downtrend line could be an indication that the bears are losing control of the market and the bulls are becoming equal or maybe even going to overpower the bears and take the stock back higher. All right. So when traders build trading models, the whole idea with a trading model is to keep you from guessing. All right. Now, I know a lot of people out there listening probably know what I'm talking about. They guess. They see something in a chat room. Their friend tells them something. They buy it, but they don't really have a logical reason for that. Then if they lose money, they panic and they get emotional. The whole idea of trading systems, and pretty much every trading system that's ever been conceived of in the history of trading, has been made for one thing. It's to take the guesswork out of it. It's to take the emotions out of your thought process. So every trading system consists of what we call setups. That's the first part. The second part is what we call a trigger. And then the third part is what we call an exit strategy. So we have two setups here. I'm going to call this two setups. It's oversold. Oversold reverts to a stock's momentum. Momentum is how far a stock has moved in a given time period. Sometimes when things get really sold hard like this, where you can see it's just in a free fall, people are like just saying, just get me out. I don't want to have anything to do with this garbage anymore. So when it's in a free fall, or we're going to get close to this support, I'm sorry, when we're in a free fall, this indicator down here on the bottom is the RSI indicator, which measures momentum. And when it gets this low, it's showing that we have oversold conditions in the market. So we have two parameters or two setups. One, we're getting close to support. Two, we're oversold. You can look at a setup as like a get ready, get set kind of a thing. When the setups happen, it shows up on your radar screen, or we put this on the radar screen. The next thing we need to do is the trigger. The setup is the ready, set. The trigger is the go. That's what makes you get online to your broker, or call them, if anyone actually calls brokers anymore, and put your order in. Now, in this case, we would just watch this. And then if this line is crossed, it's a graphical illustration that the bulls may be taking over from the bears. So that's our trigger. The parameters say watch it, or the setup says watch, the trigger says go. So you can kind of visualize the stock, or the IBB would be like here. So now people have a hard time with this because it's a little counterintuitive, because if you wait for the trend to break, most of the time you're not going to be paying the lowest price. And that's okay. We're going to buy a little bit higher and hopefully sell much higher. But the thing is if you wait for the trigger, in this case, the breaking of this downtrend line, it makes the risk reward ratio better than if you just guess. And again, it's a little bit counterintuitive because you're not going to get the lowest price, but you got to think in risk reward ratios. A key thing in the market, and a key reason why people fail, is because they think they need to be right all the time. And being in the market is not about being right. It's about making money. So a good analogy, and I like to play golf, so I use a lot of golf analogies. I hope people don't get upset with it, but a good analogy is golf, right? If you're playing a par 3, what are the odds? You want to get a hole in one, right? But some golfers go their whole lives that are great golfers and they never get a hole in one. But if you can get the ball close, then you could end up getting a good score. So if someone is a golfer and there's a 150-yard par, par three, and they get the ball to within a foot of the hole, they didn't get a hole in one. I mean, do you think it makes sense for them to get upset? No, of course not, because they're still going to birdie and get a better score than most other people. So I know it's especially for beginners, it's kind of a hard concept to understand. But again, it's not about being right. It's about making money. In this situation here, we just are waiting for a better risk reward dynamic. I mean, we know we're not going to catch the bottom price, and that's cool. All right. So that is one of the things about, or that's the main reason why people have trading systems. And I'm not saying this particular method I'm showing you here will fit you or fit someone else. But what I'm saying to you is that you should have some kind of mechanical or mechanized thought process that you use before you buy. Because if you guess, you're going to lose. Now, let me see in the chat here. Why don't you give me a 1 if you've guessed and you've lost a lot of money? I know I have, but fortunately, it's been a long time. So we don't guess. We have to have a reason for doing things. Now, the trigger has been pulled and we're long the IBB and we bought it. Now, what is the third part of the trading model? Remember what I said. The first part is the setup. The second part is the trigger. The third part, and arguably the most important, is the exit strategy. Okay, you should not take a position unless you know how you're going to get out of it. You need to set a price target or a time limit or whatever. There's a lot of different ways that work, but you got to use one of them. All right. You got to use what fits your eye, what fits your style. So now let's take a look at how a technical trader would look at this. All right. So when we buy stock, forget breaking even. Let's just assume when we buy IBB, we're either going to make money or we're going to lose money. All right. So in either of these occasions, making money or losing money, it's going to fire up our emotions, right? Because people get excited when they lose money. People get excited when they make money. So this leads to irrational decisions. So just like we needed a specific reason to get in, we need a specific reason to get out. Now, we're going to have to think about, what do we do if we buy IBB and it goes lower? Well, a logical place to have your stop out, meaning you sell it, you're okay, you just take the small loss and you move on. All right. So where would there be a logical place to have a sellout? Well, it would be under the support level, because as long as IBB is above the support, you're fine. But if the support breaks, there's a good chance it's going to go even lower. So you would sell it out. Now, this is another difficult concept. That's not as well. It's not as difficult as it seems. But someone would say, well, gee, if the thing is at 160, why would I want to sell it at 157? Call it down here. The idea is that if it gets to 157, it's going to keep going even lower. So this is a way to think about having an exit strategy, all right, for a loss. You're going to be upset that you lost money, but it's part of the game. One of the things I always tell people is that Babe Ruth struck out more than any other baseball player in history, all right, and he ended up doing pretty good in the long run. So taking losses is part of the game. People think that the greats, like a Stevie Cohen, have like some kind of secret method or secret system that they used that was revealed to them on like a vision quest or something. And I can tell you 100% wholeheartedly, without a doubt, period, that that is not how it works. That's not how real hedge funds and the institutional world work. The common denominator of people that are successful across different styles and strategies of trading is the adherence to the risk management and understanding the emotions. Now, let's talk about, if this thing goes our way and starts rallying, what is going to be our target for taking a profit. Where am I going to take my profit? Going to make some money, going to take the wife out for dinner. What am I going to do? Well, we don't want to guess. So in this situation, what would be a logical place to put your sell order at? Well, there's been resistance at 176. So if it does rally, there's a good chance it hits 176 again and rolls over. All right. So now we have to review, we have our setups close to support, oversold. That's the get ready signal. The trigger or the go sign would be the crossing of this trend line, the graphical illustration that the bears are losing control and the bulls might be taken over. That's the trigger that gets us in. Our strategy to lose money is if it breaks this support, we puke it out and we move on to something else and we accept the fact that losses are part of the game. If it goes higher, we have our sell target here for a profit up at 175. So let me know out there if you understand, or let us know, what are the 3 parts of a trading model? What are the 3 components of a trading model? Money Mitch, I'm not sure what you mean, on close or intraday. Let me scroll back and see if I see a previous comment. You suck at options. Well, you came to the right place because we're going to fix that. Hey, Money Mitch, let me entry. So do we enter intraday or on close or intraday? Oh, okay. I see what you mean now. That's a good question. I guess personally, I use the closing price. I think the closing price is the most important price of the day. So when I'm doing my analysis for whatever it is, when I'm looking for a trigger, I'm going to use the closing price. Like for instance, here, there's a chance that IBB spikes all the way up here and then turns all the way around and closes back down here, which shows that the bears are still in control. So for the most part, I use the closing price. We all suck at options. Oh, come on now, sloth. That's not true. I'll give you a little bit of insight, though, in the option world. I don't know if I have the exact numbers right, but I think I'm pretty close. 90% of options expire worthless. Okay, think about that. 90% of options expire worthless. So who makes the money? It's the people that sold the options that are expiring worthless. So option sellers can make more money than option buyers. All right. So who's doing all the selling, of these options is the market makers. They know this thing is, overpriced. So some retail traders are coming in to buy it. I'm going to sell it to them. But just keep that in mind. And now don't go out and start selling options without doing a little more research, because you can really get yourself in a world of hurt. One thing I would tell our conservative investors is to consider is a covered call strategy. What this means is, say you own a stock and you like it, you want to hold on to it, but you don't think it's really going to move anytime soon. You expect it to trade sideways. Well, what you can do is you can sell a call on that stock, and that brings some money into your account. And if the stock doesn't move and the call ends up expiring worthless, you get to keep that money. So investors looking for income, or investors who think that their stocks are kind of trading towards a top, that's something you should definitely look into. It's called a covered call strategy. Worst case scenario is like this would work like this. Like, say you owned, let's just bring up, I know it's not a biotech company, but let's just bring up Ford here. Now, say you own Ford and you think it's going to go down, but you don't want to sell it. You want to hold on to it. Well, say there's a call out there that has a 16 strike price. That means if the stock is above it, the call is going to have value. But if the stock is below it, the call won't have any value. In this situation, someone who owns Ford could sell the 16 call and get the money. The worst case scenario for them is if the stock gets above 16, they'll be forced to honor their contract and sell it at 16 and forgo some of their gains. But they brought in a little bit of extra money, and they're still selling it above the market. So, I'm not recommending you do it, but if that's something that sounds interesting to you, I would recommend at least looking into covered call strategies and doing a little bit of research. African culture, what time frame do I normally use? Just, I would say my personal time frame, just because it's just what I'm used to and what I've been doing for the last 2 decades is, I look at things kind of weekly and monthly. I'm not a day trader specifically. So I like looking at weeks, but there's really no right way to do it. Some people might be good day traders. Some people might be good swing traders, and that's referring to people that are trading for longer than a day, like a couple of days or weeks. But here's the thing, right? Say you buy a stock and you have your target price, okay? If the stock gets to the target price in one day, you're going to sell it. If the stock, doesn't break out or doesn't break down and you don't get stopped out, and it gets to your price target in a month, you're going to hold the position for a month. If it takes 2 weeks to get to your target, you're going to hold the position for 2 weeks. So the point is that you don't have to worry about the time frame. If you have the sell strategy in place, the market's going to tell you what the time frame is. But that's a good question. Corey says, I heard for the first few minutes of the day, the open usually will tell you if a stock will go up or down on the day for an interest. I don't know if I would agree with that. I've seen plenty of times where, stock opens up and then rolls over. One of the things that can happen is we have what are called reversal patterns. And they look at now this is actually a good example of Ford. Okay. There was a sign that the sell-off was coming. Now the bulls, with these candles, a blue candle is a day that is up. The open is at the bottom, and the close is at the top. So now a red candle is a day that's down. The open is the top of the candle and the close is the bottom. So this day here for Ford, it actually opened higher than the next day. So if you looked at this in the morning, you would have said Ford is up, and it went up even a little bit higher. But by the end of the day, the sellers came in, it turned around, and they knocked it lower. So this is an example where a stock looked really strong in the morning, but by the end of the day, it had reversed.
Mark, I'm popping in here. How'd it go,
cool.
man?
Thanks.
Did you always get this kind of reception? The chat is loving it, man.
Yeah, I mean, so far so good.
Where can the crowd get more of your awesome technical analysis? Is it Benzinga.com content? Is it on the trading school?
Well, unfortunately, for now we're at capacity in the trading school.
Ooh.
So we're not going to. We don't have plans of accepting any new students at this time.
Okay.
But I would suggest that people who are interested reach out to Rodrigo, and maybe if we get some people that drop out or quit, we can fill up those spots.
Love it, man. And maybe Aaron, can you put? I think this is okay. Can you put Rodrigo's email up on screen so I can give him an easy shout? And you do some content for Benzinga, right, Mark?
Yeah, I do some
So,
stuff on the Benzinga Newswire. I have a penny stock idea that I put out every Monday morning.
oh, and yeah, it's a Mark's Penny Stock Ideas visit, and there's a Bitly link that just got dropped in the chat. And if you have an author profile on Benzinga.com, I believe it is just Benzinga.com/author/your name to see your content really quickly. So this has been really good stuff. I love the little teaser there for the Benzinga Trading School. Hopefully, if people in the chat are more excited about this kind of a technical analysis, like Mark said, give Rodrigo a shout. Let him know that you want in, and maybe we can see what we can do here.
No, I don't have a Twitter account right now. Sloth.
Sloth with the good
like your
question.
handle, Sloth Alliance. That's a good one.
All right, Mark. Well, this has been awesome. I am going to do another of our Slido poll here. We're going to have a contest winner a little bit later. They're going to be winning a 1-year subscription to Benzinga Pro. So I'm going to let you hop off, Mark, and I'm going to go to the Slido here, if that's cool with you.
Cool. All right, Brad. Thanks a lot. I really appreciate it. And thank you,
Yes,
everyone,
sir.
for listening. I appreciate your time.
Until next time, we will see you around soon, Mark.
Okay. Thank you.